Good afternoon and welcome to this week's edition of Halftime Talk. We're joined for the final episode of 2020 by Carole Nakhle, the CEO of Crystol Energy. Good afternoon, Carole, and welcome.
Hello, Sean. Thank you very much for having me on this. What is going to be hopefully a very special session, since we're going to look at what happened this year, a remarkable year that we're going to remember for decades to come.
Certainly will. And we're sitting here now on towards the final weeks before Christmas 2020, and oil prices have recovered above $50 a barrel, just hanging on above $50 a barrel. Looking back at this 12 months behind us, Carole, what stands out? What are the top 2 or 3 things that you're going to take into your Christmas dinner and think about, or maybe at least pontificate a little bit about at the end of this year that might need some thought ahead of next year?
It's no brainer, Sean. I mean, the first and most important thing that we will be still talking about well into next year and has dominated and defined this year is COVID, the pandemic that has changed our lives upside down and brought in many challenges and caused structural changes to our economies, to businesses all around the world, to government budgets, you name it. And everything else, in my opinion, whether it's economic growth or oil market performance, are just footnotes to the pandemic. But here, before perhaps I elaborate a little bit more on the oil market, which is perhaps most relevant to our discussion today, there is one thing that is particularly striking about the pandemic, that is how poorly prepared organizations and governments, private sector, public sector, were for this kind of incident. We did at Crystol Energy a survey earlier this summer to see how prepared companies were for this kind of risk in the pandemic, and the majority were not prepared at all to deal with this kind of crisis. So it makes you think about our risk scenario analysis, what kind of risk we have been capturing in our analysis, and did we really miss on something as crucial as the pandemic? And mind you, it's not just the private sector. Even, for example, you look at the West, in Europe and the North America, where they are still struggling to keep the virus under control. They received warnings early in the year, and yet a few months later, they were ill-prepared. If you remember, they had shortages of masks, of hand sanitizers.
You remember people scrambling just for simple, what you would think standard equipment for masks, gowns,
exactly, safety gears, exactly. And this makes you think about whether we should revisit our risk scenario analysis. So that is, for me, the big picture. And for next year, now that we have vaccines out and people started to receive them, at least gradually in the UK, then hopefully all around the world, the next year, the question would be, first of all, whether you will get really that infection or that pandemic under control. And for me, it would be like, okay, we extinguish the fire. Let's now assess the damage. So
I mean, if you look back at what you referenced there, the lack of preparedness, in essence, you're kind of saying there was a complacency in Western economies that governments and or corporates were ready, they're operating. If you look at how supply chains have moved over the decades, to this point in which we're now operating in real time, next step supply chain, the countries were operating with some sense of, I don't know if it's economic complacency after 10 years of significant amounts of monetary easing. We got a huge, the idea that you can easily fall back on, let's just print more money. In some ways, the Western economies have been caught off guard by this crisis and have performed rather poorly.
Yes, and I would add to all what you listed, actually, they kind of fit into the kind of supply chain bottleneck. Another event, which is perhaps not related to the pandemic because it started before the pandemic, but it was accelerated or amplified by the pandemic, is the trend towards de-globalization. And of course, we'd link that, I don't want to link it to one person, but of course, President Trump played a big role in the kind of breaking down of the international global order. But what brought him to power was partly that, because people were protesting against, the big economy, the integration of global economies. So that was something that was already happening before COVID-19, only to be amplified by the pandemic, accelerated or highlighted as dangerous to our world today. Now, the big question that poses itself for next year is, again, once we contain this pandemic, are we going to reverse the de-globalization trend and move on towards better integration of the global supply chain? Here, again, I want to look at the US with President-elect Biden, who seems to have a much more milder and diplomatic approach than President Trump, and what role he will play in bringing back, the conventional relationship between countries, between economies, whether with Europe, whether with Asia. Of course, doesn't mean that going back to business as usual, be on new conditions, but it would be probably a restoration of this global supply chain, which is much needed to face the current economic crisis that we are facing.
If you look at the point of complacency in the economic performance and social performance, obviously, with the amount of mortality and that has hit the West, but if you look at it from an economic discipline point of view, the West went through this complacency in the preparedness wasn't there. Then when the first wave subsided, that sort of complacency returned over the summer. And then the second wave now deep into the winter in Western Europe and North America has been devastating. But yet in Asia, the discipline that they've demonstrated in managing their economy and managing their society, the discipline required to meet a challenge like COVID, the Asians seem to have it, the West seem not to have it. And you wonder what the implications for that will be as we move forward. A disciplined economic performance, a relatively erratic one.
Well, here, Sean, I mean, there is a combination of cultural factors. So I would say in Asia, not just, I'm not talking about China, but even if I include the Middle East as well and other Asian countries, you find that there is I don't want to say like a bigger responsibility towards the community than what you find in the West, but there's definitely the cultural element because we think more of the community rather in an individualistic way, as you find in Western cultures. But there's also the other element that I don't know whether it's a plus or a minus, that in democratic societies, you are limited by what you can impose on your people. I mean, here in Europe, people were, in the US in particular, they felt that it was taking away their constitutional right if they were
That
to
for
wear
me
masks.
I mean, that's not freedom. That's not constitutional
That's
civic
how you
freedom.
see it, Sean, but they see it
It's just
differently.
a nonsense, and this is a health emergency. You don't go running in front of a car when it's driving down the street just because you're free to do so. I mean, this is a part of the discipline of being able even to identify what is the problem. It's not a freedom issue. It's a national health emergency, and I think in that way, the future doesn't bode well if the West and democratic society distort the difference between those two things.
But individuals don't see it that's the way they see it. It's an individualistic society versus collectivist society as we have in Asia. It's like, gun rights. Well, I mean, they feel it's their own right to hold guns. And the same way, it's up to them to wear a mask or not. They don't think about the major consequences on other people's health. But mind you, I mean, I don't want to be too judgmental about how they think, but we are dealing still with a virus which is new, and the scientists have not reached, a final conclusion about how to deal with the virus. So there's lots of unknown, lots of misinformation out there. And here I want to blame also social media, because I mean, my God, if you just watch a couple of these conspiracy theorists, you say like this, you would imagine that COVID is something that has been invented to contain certain people. So there is a lot of misinformation out there that distorts an already individualistic way of thinking.
Yes. Looking back beyond the sort of macro sense of the economy and society within the oil patch in particular, what would you identify as some of the key takeaways from the year?
Several, but I would say, I mean, first of all, it's a reminder of the kind of volatility to be expected in the industry. I know that OPEC Plus or OPEC in general has been focusing on achieving market stability, but oil markets are complex and big, and achieving market stability comes at a very big cost. And oil price volatility is an inherent risk to the oil and gas industry right from the beginning of the oil industry. So this is nothing new, and to contain that volatility requires a giant effort, a mammoth effort. That said, the positive side in terms of what OPEC Plus has achieved for me, apart from pushing prices higher and stopping them from falling further, mind you, in April we saw negative prices for WTI, but I would say is that OPEC has maintained its relevance despite being 60 years in business and despite many people attacking it, and despite the divisions within its members. Everybody today is watching closely what OPEC is going to do, whether it's going to put an upward pressure on prices or downward, that would be secondary. But the main thing is that OPEC has remained relevant to the oil market 60 years on. And that's why I don't think they are going to go anywhere anytime soon.
I mean, how would you define the difference there? And maybe you're referring to both, but ultimately OPEC plus 23 countries rather than OPEC 12 or so countries. I was wondering, if 2020 legacy is anything, it seems to me that it's really all about OPEC plus now and no longer just OPEC by itself. It doesn't have the weight or the velocity in which to correct such huge challenges like we saw this year.
Definitely. I mean, you're talking about a very big challenge, and a challenge such as what we saw this year requires something much bigger than the conventional market structure if you wanted to safeguard, to salvage the prices. And that's where, but mind you, OPEC Plus did not exist today. They came together in December 2016, then to face a different kind of challenge. But that is in the short term. If I want to look at it more in the longer term, again, most of the countries within OPEC are in a strong position, of course, conditional strong position, because they are much lower cost producers than other, let's say, countries within the OPEC Plus arrangement. But their weakness is that they depend more on oil revenues than countries in the OPEC Plus. And here I'm thinking particularly about the two main actors, Saudi Arabia and Russia. And we're going to see how the dynamics between the two are going to play in the future. But at the moment, of course, it's OPEC Plus. In the longer term, I'm not ruling out that OPEC may still be as relevant as it was in the last years.
I mean, ultimately, we had the amazing reduction in supply. Ultimately, 10 million barrels of oil supply a day was cut back in order to try and meet the challenge of 20 million barrels a day of demand destruction. Supply side, it seems to have done its trick. It's recovered prices to $50 now at the end of the year, but demand, alas, remains elusive.
Yes, and demand has always been the least understood fundamental compared to supply. So you find most commentaries today, they focus on the supply side, they focus on OPEC, but mind you, today it's a demand shock. And if you look at the forecast for next year, they are quite reserved. So even OPEC revised downwards, yet again, in its latest oil market outlook for next, the monthly outlook, they revised their predictions for the demand for next year. Now, one could argue that they have always been more cautious than, let's say, other forecasting agencies such as the IEA or the EIA, because it's the prerogative of the producer that could give them a bigger incentive not to simply open the tab and lose discipline within the group. But the demand is affected by many factors, particularly by the health of the global economy. And if you are not expecting the economy to rebound strongly, yes, the vaccine is out, yes, it's going to support economic growth, but the pandemic not only affected our health, but it has caused structural damages to the economy because it has not been contained quite quickly. And those structural damages are not going to evaporate overnight with the vaccine. They are going to stay and they're going to linger with us for many years to come. Think about the size of the fiscal stimulus packages around the world. Think about the debt in the developing countries. This is going to cause more and more problems in the longer term, or people who lost their jobs, or companies who went bankrupt. So all these are not going to be restored overnight next year, and that will continue to put a lid on oil markets, on oil demand. Then there is, of course, the transport sector. If you look at various forecasts, you can see that it's not going to be a magic trick where suddenly everybody's going to resume their traveling as they did before the pandemic. And as long as the transport sector has not gone back to its pre-COVID level, I think we should be quite cautious with our forecast for oil demand.
How do you think the members within the OPEC plus and OPEC in particular, the individual countries, have performed economically? Have they taken a sufficient advantage of this moment in which to make structural changes? We've seen moments of, let's say, Saudi Arabia increasing VAT from 5% to 15%, a quite austere move. But ultimately, structurally, what is your analysis now at the end of 2020 in terms of the structure of the oil producing countries after such a shock?
First, it would be a little bit misleading to just simply focus on their performance at the moment, because you have to see how they entered the crisis, what kind of health in terms of economic conditions they face this crisis. And it pays to look at the last even 20 years from the 1990s onwards. So they went through, first of all, a period of 10 years of saving, and they were very careful. And then 10 years later, they opened the tap. And when they started this COVID this year, if you look at their economic growth, I'm talking here about particularly the GCC countries, or if I look at the MENA in general, oil exporting countries, you can see actually they had a slightly negative growth to start with at the beginning of the year. If I'm not mistaken, it was 0.3% negative. So they already they entered a massive crisis in a weaker economic strength than, let's say, other countries or the rest of the world, and therefore hit by the double whammy of COVID, which put a lot of pressure on their health system and their economy, and a massive collapse in prices, and a massive constraint of their production. So no wonder their economy has been hit badly. And again, they would be struggling for a while, even if oil prices recover. And we shouldn't only look at the Saudis or the UAE. And of course, one point to mention is that not all OPEC plus members are in the same category. You have better performers such as the UAE and Kuwait, primarily because they have a sovereign wealth fund that supports their economy in difficult times. And you have on the other side of the spectrum, on the other extreme, countries such as Iraq and Nigeria and Angola, which are really struggling with their economies. So, but put that aside, again, the shared feature between these countries, an additional feature, is that they lack economic diversification. Economic diversification protects you against these kind of conditions that we are facing today, because yes, you have an important sector for your economy, but if that sector suffers because of a decline in global prices, then not all your economy is going to suffer. Look at Norway, for instance. They remain a major producer, but the economy is better shielded than what we have in the Middle East. That said, when you look at historically, and this is again for me the silver lining, whether it will materialize today remains to be seen. Usually when you have economic crisis and a sustainable period of low oil prices, that by itself provide the incentive for these economies to implement reforms. In 2016, Saudi Arabia announced very ambitious reforms. And I think that is the risk, that when you set very bold agenda, you realize later, as soon as oil prices start to recover, you kind of either postpone some of those reforms that you announced, or simply cancel or delay, and then you fall into this vicious circle again. But hopefully today, these countries realize that they cannot continue with business as usual. And there is an additional dimension, Sean, if you allow me. I know, I tend to look for the very long term. If you bring in the energy transition to the picture, actually the energy transition by itself has given economic diversification a new sense of urgency, because we have low-cost producers, and the low-cost producers will be the last to leave the market in a shrinking market during the energy transition. So, but if you don't have economic diversification and you're still desperate for higher oil prices, you will not be able to build on your competitive advantage. But if you diversify your economy, then you can sustain with strength lower oil prices. So I think it's beneficial for the short term and for the longer term.
Well, it's been quite a decade when we come to the end of 2020. When you think the first half of the last 10 years, $100 plus oil, perhaps that was the window, 2010, 11 to 2015, in which to really make some structural changes from a position of strength. The last 5 years since prices collapsed in 15, 16, it's been a weaker period and difficult to make the kind of changes under austere circumstances. But let's look forward, because ultimately it's the end of the year. We're looking to 2021. It looks like we're going to end the year in and around $50 a barrel. What do you think the first half of next year? What are the things to look to? Inevitably, the vaccine has started to be rolled out at the same moment that COVID 2.0 is ravaging the biggest economies in the world.
Well, for the first half, I don't expect much changes from what we are seeing at the end of the year. So for oil prices, they finally moved out of a stubborn range, which was between 40 and 45, which lasted between June until November this year. And now they increased maybe by a few dollars more. And we wonder whether this is going to be the next range within which, like 45 to 50, whether they will be stuck in the first half of next year. But it's not just the demand which is going to determine the outlook for prices. We're more or less, we have an understanding the demand is not going to change drastically, at least in the first half. The factors that will change drastically, at least in the first half, and will play a major role if they happen, is OPEC plus discipline, their decision what to do in the first months of 2021. Yes, we know that in January they are going to put in the market no more than 500,000 barrels a day, but they did not provide us with much information to know whether, how they're going to impose a discipline and stop the cheating members from continuing cheating. You see, some people said that only the 500,000 barrels helps to improve the compliance of the organization, but it's not going to put extra barrels in the market. Well, yes, if you take into consideration the cheating and you tell the members that you should stop cheating, but if you're not going to stop the cheating, then it's going to be more barrels coming to the market. So you haven't really changed much there. So there is the OPEC plus decision, how much they will put in the market, whether they can maintain compliance. And mind you, again, when prices start to increase, especially when you have record spare capacity for OPEC, then you have less and less compliance within the group. And there is, of course,
you had the announcement yesterday by OPEC itself downgrading their demand recovery next year. I mean, you're talking about 5 million, I think the number is, in a give or take at this point, of recovery. That would seem that they'd leave about 5 million still on the sideline. So it could feel quite competitive next year as countries compete to have some market share back.
Yeah, I mean, but if you look at their outlook, while they downgraded their demand forecast for next year, they increased the call on OPEC, so on OPEC oil. So that could mean, that they are seeing that there could be room for further relaxation. But the other factor that we should not forget is production from outside OPEC or OPEC plus, including the countries which are currently exempt, like Libya. It may not go back, but Libya's production is dictated by politics. It may not fall back, but it may not increase, but still putting this amount of oil in the market is a lot. But for me, the biggest factor that tends to be overlooked, or maybe people think that's over, is what's going to happen in US shale. I know that, it has been bruised badly, but so is your industry globally. State-owned or privately owned companies are suffering the same thing as shale, but maybe in shale is more amplified because of the structure. You have more players, smaller players, with when he's starting with shaky financial situation. But if you look at the latest surveys coming from the shale industry, you see there is much more optimism today that oil prices had hit, are closer to 50 or going to go a little bit beyond 50 in terms of significantly boosting drilling activity, or rig data is going to look better in the first half. So here again, the challenge is not just about the demand increasing or not, but what was happening on the supply, because it's a race between demand and supply, and who's going faster to allow the record inventories to be absorbed and brought back to 5 years average. That will take more time.
The point you make about shale is one of those unknowns, isn't it? That what will be the sentiment of the Biden administration? Will they be accommodative of gas flaring and, drilling, exploring on public lands and other things that the current administration has facilitated? Or will they be restrictive? Will Wall Street provide the finances necessary for companies in which to invest? We saw yesterday ExxonMobil announced themselves they're going to be trying to reduce their own carbon footprint. So a lot about the shale recovery will be oil price, but also the sentiment of the regulations of the new Biden administration could dictate a lot.
Indeed, there are lots of unknown with Biden administration, with his tone and his priority placing climate change among one of its main priorities to tackle. That is definitely something the industry is concerned about. But again, here we don't have much detail. So if you look at the announcement of the policy, it was just mainly a headline that appeals to the voters and that appeals to those who support the Democratic candidate. What that would translate in terms of practicality, in terms of impact on investment, that remains to be seen. And there is one thing I have to remind here, people, that the US remains one of the lowest tax jurisdictions for oil and gas investment. So yes, there are the challenges on the regulatory aspect, but I doubt that that Biden is going to simply kill an industry that creates so many jobs and still generates a lot of revenues for the government. And it can be a base for them, for the Democrats, for future, for the next round of
Well, I
elections.
suppose
So
it's about whether we recover the 2 million, million and a half, whatever the number
it
is
doesn't
at the
matter the
moment.
scale, Sean, because the market is not the same size as before. So it's not
Right.
about going back to 13 million, even at 11 million or 11.5 million in a smaller market, that still means that there will be competition for market share between the US, Russia, and Saudi Arabia, or the US and OPEC more broadly. So focusing
What
on
a,
13 million, the peak reach, is a bit
right,
simplistic rather than taking the
right.
bigger picture.
I mean, the other big development this year that will have potentially implications for next year is on this point, the huge amount of capex cuts that were made in 2020, up to 20 to 30% of future oil supply investment. When do you think that will have a kind of a frontline impact on price, on meeting future supply?
You touched on one of my favorite subjects, because I like to challenge the conventional thinking about this concept of investment gap. And I really would like it happening one day, just to see the others, where these other people were coming from. Because if you look at all the warnings, at least over the last 10 years, people warning that the lack of the decline in investment. So I don't want to look at the last 10 years, but maybe from 2015 until today, we have perhaps where we are today with capex is maybe half the level that we had seen in 2014, 2015. Of course, if you just look at the value, you have a good reason to worry, because you say, oh my God, we're not going to invest. But if you plot along this value, the oil price and the cost. So if you look at how the cost is reacting, you can see that's not as bad as people think. And with cost, I talk about OPEX and CAPEX, so operating expenditures and capital expenditures. We see that they follow the oil price quite closely, yes, with a certain time lag of 6 to 18 months, depending on where you are investing. But there is another element, which is really my area of specialization, that is government policy. So we mentioned Biden perhaps taking stronger stance on the industry, but everywhere else, or most of the places, usually what we find, especially in an era where capital is constrained, governments start to compete for that capital, for the same capital. And therefore, they tend to revisit their regulations, their licensing terms, their fiscal terms, to alleviate the burden on the oil companies. So it would be a bit simplistic to say that $100 of investment last year is buying me the same investment today, or that $100 today and today $50, therefore we're going to have a crisis, because $50 may give you the same project as $100 if you have lower cost, lower government take, more relaxed investment environment. So that's one thing we should keep in mind.
And cheap
The
money.
relationship between, exactly, and the relationship between investment and oil price is not that straightforward.
Carole, just to wrap up, is there anything else you would like to point out regarding the coming year before we conclude our interview?
I'm quite optimistic about next year, because I don't think it's going to be any worse from what we saw this year on many fronts. But it doesn't mean that that's it, the crisis is over. I said earlier that we extinguish the fire, hopefully next year with the vaccine, with keeping the pandemic under control. But then it is like the sobering time of assessing the damage, and that damage will not be corrected quite quickly. It might
I
be
mean,
with
like
us
you
for
said,
several times.
the first half of this coming year could look a lot like the second half of 2020.
So things will look better towards the end of next year, including the oil price. If you look at major forecasting agencies, they are expecting higher prices by the end of the year. But economically speaking, things will take a while to be restored. And the transport sector, which remains crucial to oil demand, will take time to restore. So I don't think we should really look at next year as a turning page. It's just a beginning of a gradual process of adjustment.
Well, most oil price forecasting we have done has indicated that expectations are an oil price closer to $50 than 60, which would sort of leave you more or less in where we are at. Carole, Nakhle, thank you so much, the CEO of Crystol Energy, not only for your interview today, but for your participation throughout our season of daily Energy Forum webinars. It's been absolutely brilliant having your insights, and we look forward to 2021 for another great season of interesting analysis. Thank you, Carole.
Thank you, Sean. I have to say, I enjoy so much your morning sessions, and you're the only one I would wake up so early to participate in because I really enjoy them. So thank you for the opportunity, and I wish you all the best for the new year.
And Merry Christmas, Carole.
Same
Thank
to
you.
you.
Yalla,
Bye-bye.
ma salama.
Ma salama.